Ruth Lea.
Could I start with the issue of the economic sovereignty, because I actually take strong issue. I think when Ken and Eddie get together every month, they actually do decide what British monetary policy is. Would you agree with me on that point?
No, I wouldn't. I think Ken and Eddie are second-guessing what the international financiers think.
No, I think that's quite wrong. I think what you see is that they have to have responsible monetary policy, else you will get knock-on effects in the pound. But so does the Bundesbank, and so does the United States Federal Reserve Bank, and so indeed does any other central bank throughout the world.
But, I mean, surely the main worry that Ken and Eddie have at the moment is the high rate of our currency, and they're worried about how that currency can be kept under control and at the same time control the economy.
True.
And those are all responses to international pressures, not national ones.
True, but they can still decide what they want to do with interest rates, and I think this is one of the key points that I want to get home tonight. After all, a fortnight ago when they sat together, they weren't just discussing the football results, they were actually saying, what interest rate do we need now in order to be able to run our economy efficiently? What do we need to be able to control inflation? What do we need to be able to ensure that growth actually continues?
And they were also making quite sure that the Bundesbank agreed with what they were saying.
That is certainly not true. And I strongly contest that point, because they were perfectly capable of deciding whether they put up interest rates from 6 to 6.25% or from 6 to 5.75%, and they were not ringing up the Bundesbank to decide that.
I think they keep a very, very close eye on the financial markets, particularly Eddie.
They certainly keep a close eye on the financial markets. No one disputing that, because I've already said that if they're going to be having good monetary policy, they have to be responsible to the markets. No one's disputing that, and they are not alone in that particular remark.
And with the single currency, they'll have fewer markets to look at.
Right, well, let's have a look at the single currency then, because we won't have the Ken and Eddie show every month anymore. We'll have European central bankers sitting around, non-elected European central bankers, deciding on the interest rate that is right for the whole European area. Now, that's going to be extremely difficult to engineer, isn't it?
It will only apply for those members who've met the convergence rules, and by meeting the convergence rules, they would be running responsible economies as they enter. As oddly enough, this country appears to be about to do. For the first time for a number of years, we are behaving responsibly. Well, and that's the reason why the issue of the joining the euro is on the agenda today.
And do you think those convergence criteria are adequate? Because I certainly don't, and perhaps I could go a bit further on that. I think there are very fundamental differences between the way the British economy works and the way that the economies on the continent of Europe work. And unless those particular differences are ironed out, then you are not going to be in a position where an interest rate that is right for Germany or right for France is going to be right for Britain. And then if you get the wrong rate for Britain, which is a very good chance of doing that, that will be disastrous.
Well, the whole issue of convergence is to make sure that the very things you're worried about don't happen. And if the people fudge the convergence rates, then it won't happen, because the financial markets will not allow this game to go on if people are cheating.
But convergence criteria are about long-term interest rates, they're about inflation, they're about fiscal deficits and fiscal debt. They are not about how economies react to changes in interest rates. And the truth is that the British economy, for example, is much, much more sensitive to changes in short-term interest rates than the German one. It's because we have a lot more short-term debt. You can't, that is not even one of the criteria.
A gentle reminder that it's questions rather than statements.
But fortunately, in this particular instance, because Mr. Clark is behaving in a relatively responsible way, our long-term interest rates are reducing. Nearly 50% of the mortgages now being issued are long-term mortgage rates. But so the worry about volatile short-term interest rates is declining with sound monetary policy.
And there's still a stock of debt in this country, which just still means that we're much more sensitive to short-term interest rates. Moreover, and I know that I meant to ask a question, there is also the issue of the business cycle. Does it worry you that the business cycle is very adrift between Britain?
Again, if we converge and if we apply strict monetary disciplines, we will converge and the cycle will disappear.
Okay,
well,
thank you,
Ruth
Lea. Your red light is on. Chris, and have two closing statements. First of all, Ruth Lea.
Well, I have a minute to sum up a very complicated debate, so actually I'll just stick to one main point. Basically, if it ain't broke, don't fix it. And as far as I'm concerned, the British economy at the moment is being run really quite extraordinarily well, for the best I've seen for years, and I've been studying the British economy for 30 years, so I think we should just remember that. Yes, Ken and Eddie, our Chancellor and our Governor of the Bank of England, are running a very good show. They decide interest rates on the basis of what is right for this country. Now, if we go into EMU, what will happen is that won't happen anymore. We'll have no more Ken and Eddie show. We will have these non-elected central bankers in Frankfurt deciding what interest rate is right for the whole of the European area. And there is a very, very good chance, because our economy is so different from the German or the French economy, that those interest rates will be wrong for us. That would be economically disastrous. If the interest rates were too high, we'd just have a rerun of the exchange rate mechanism, you'd have recession, you'd have high unemployment, you'd have job losses. It would be an appalling situation. And even if interest rates were too low, that's not a good thing either, because you would get inflation and instability. So what I say is, stay out of EMU and let's run our own economy according to our own needs.
Thank you very much.